Why Bitcoin will go to $1 million a coin by 2030. Bitcoin is trading right around $62,000 a coin as this is being recorded, which, depending on how you frame it, either sounds wildly far from $1 million or sounds exactly like the kind of beaten-down setup that's preceded Bitcoin's biggest rallies in the past. It's worth being upfront about where things actually stand right now. Bitcoin's all-time high was $126,198.07, hit back in October of 2025, which means the coin is currently trading at roughly half its peak value, deep into what most of the market considers bear territory, with sentiment indicators showing extreme fear rather than greed. So a script claiming Bitcoin is about to march in a straight line to $1 million would be ignoring reality. But the more interesting question, and the one worth actually digging into, is whether this kind of brutal drawdown is part of the same boom and bust pattern that has always preceded Bitcoin's largest moves, and whether the structural changes happening underneath the price right now make $1 million coin by 2030. A serious possibility rather than just a number. Someone made up for a thumbnail. Start with the historical pattern, because it's the single strongest piece of evidence bulls point to. Bitcoin has only existed since 2009, and in that short span, it has risen more than 15,000%, a number that sounds almost fictional until you remember it includes multiple separate collapses of 70% or more along the way. Bitcoin ending a calendar year roughly 30% below its all-time high, which is close to where it sits today relative to last October's peak, isn't a new phenomenon. It's practically the rule rather than the exception. Every previous Bitcoin cycle has followed a similar shape. A blow-off top, a brutal correction that convinces most casual observers the bubble has finally popped for good, and then, eventually, a new cycle that pushes the price to fresh highs once adoption catches up to the previous run's speculation. If that pattern holds one more time, today's fear and today's $62,000 price tag are simply where the chart sits in between cycles, not where the story ends. What's different about this cycle compared to earlier ones is the depth of institutional infrastructure now sitting underneath Bitcoin. Spot Bitcoin ETFs have made it possible for everyday retirement accounts, pension funds, and traditional asset managers to gain Bitcoin exposure without ever touching a crypto wallet, which has fundamentally widened the pool of capital that can flow into the asset compared to the early retail-driven cycles. Bitcoin's market capitalization currently sits around $133 trillion, comfortably ahead of every other cryptocurrency, with Ethereum a distant second at roughly $233 billion. That gap matters because it shows Bitcoin has maintained its position as the default store of value crypto asset, even through a brutal drawdown. The same role gold has played in traditional portfolios for centuries, except with a fixed, mathematically guaranteed supply cap that no central bank can expand. That fixed supply is really the foundation of the entire long-term bull case, and it's worth spelling out plainly. There will only ever be 21 million Bitcoins, and over 20 million of them have already been mined, meaning the remaining new supply entering the market every year keeps shrinking on a fixed schedule. Compare that to traditional currencies, which governments can and do print more of whenever they choose, and you start to see why some investors treat Bitcoin less like a speculative tech stock and more like a hedge against currency debasement and inflation. If even a modest percentage of the world's gold market, sovereign wealth funds, or corporate treasury reserves rotate into Bitcoin over the next several years as a digital alternative to gold, the math on a fixed 21 million coin supply gets dramatic very quickly, since there's no way to manufacture more coins to meet that new demand. Corporate and institutional adoption continues to be the wild card that could accelerate this thesis, faster than historical cycles alone would suggest. Companies like Tesla and Ferrari have at various points accepted Bitcoin directly for purchases, and a growing number of public companies have added Bitcoin to their balance sheets as a treasury reserve asset rather than holding cash that loses purchasing power over time. Every company, country, or large fund that adopts Bitcoin as a reserve asset, effectively removes coins from circulating supply for the long term, since these holders tend to behave more like long-term accumulators than short-term traders. If that trend continues to expand, even gradually, it tightens available supply at exactly the moment overall demand could be increasing. None of this should be mistaken for a guarantee, and any honest script on this topic has to say so directly. Bitcoin remains one of the most volatile major assets in the world, capable of losing tens of thousands of dollars in value within a matter of months, exactly as it's done over the past year. Regulatory risk is real and unresolved in many parts of the world, and a hawkish shift from the Federal Reserve, like the one currently being discussed, tends to pressure speculative and risk-on assets, including crypto. There's also no fundamental cash flow, earnings report, or revenue line underpinning Bitcoin's price the way there is with a stock, which means its value is driven almost entirely by supply dynamics, adoption trends, and shifting investor sentiment. Three things that can change quickly and unpredictably in either direction. So how do you actually get from roughly $62,000 today to $1 million by 2030? It requires Bitcoin to roughly 16x from current levels in under 4 years, which sounds extreme until you remember Bitcoin has delivered moves of that magnitude, or larger, multiple times already in its short history. It doesn't require a smooth, steady climb. It requires 1 or 2 more full boom cycles of the kind Bitcoin has already lived through repeatedly, layered on top of continued ETF inflows, growing sovereign and corporate adoption, and a fixed supply that simply cannot expand to meet new demand. The case for $1 million Bitcoin isn't really a bet that this asset behaves differently than it always has. It's a bet that the same wild, cyclical pattern that has defined Bitcoin since 2009 has at least one more massive cycle left in it before this decade is over, and that the structural pieces now in place make that cycle larger, not smaller, than the ones that came before it.